Good afternoon, everyone. Welcome to the etmarkets.com webinar. The growth in currency futures and options in value terms was as high as 49% in 2015. While the currency market has constantly been under turmoil over the past few months, many investors have not been able to use these instruments to play in the currency market. Today, our guest, Ms. Huzan Mistry, Chief Business Development, Currency and Debt Markets at NSE, will give you a lowdown on new age products in NSE so that you can explore your options in the currency FNOs. She will make her presentation shortly. Thereafter, she will field questions from you. You can keep posting your questions in the little chat room on the right side of your screen. So stay logged in and pick your money-making ideas. Over to you, Ms. Mistry.
Thank you very much. I'd like to take this opportunity to thank ET for the opportunity here. And it gives me great pleasure to introduce people to the currency derivatives segment that's been active at NSE since 2008. Without further ado, I'll get into the presentation and we'll take questions after that. Thank you very much, everybody who's joined in. We appreciate your interest. Briefly, what I'm going to talk about is how foreign exchange is an asset class that people can actually trade today in India, even as a resident Indian individual. How the dollar rupee or the rupee movement affects every individual, corporate entity, investor, trader, hedger, etc. Then I will briefly touch upon the product offerings and how some strategies work when you're using our product on the exchange. What are some of the market dynamics in place? Lastly, what is the participation process if you're looking to trade or hedge using the currency futures and options market? Foreign exchange is actually one of the largest traded asset classes globally. It trades on average about 5.3 trillion a day. India, of course, is smaller, but is at around 31 billion US dollars. It's traded, has historically been traded in the OTC market, and exchanges introduced the dollar rupee as a product in August of 2008, and we've been trading that since. We also trade other currency pairs, which are the Euro INR, the Sterling INR, and the Yen INR. As I mentioned earlier, it is an asset class that now through the exchanges is available to even to every resident Indian individual to trade on. It can be traded very similarly to how we trade equities and commodities. I'll just briefly touch upon how foreign exchange is quoted and traded. There is, as I mentioned, we trade the dollar rupee as in the USD INR, the base currency being the dollar here, because we're talking about for every $1, how many rupees do I get? So for example, if USD INR is 68, what it means is that for every single dollar I get 68 rupees. Or to buy $1 US, I would have to pay 68 rupees. If you see the chart here, it, I think, adequately proves that the rupee is an asset which moves, has volatility, and therefore needs to be managed if you are a corporate entity and you have foreign exchange exposure, whether you have a loan or whether you have an export or import or whether you have capital flows as a foreign portfolio investor or you are a local company who's investing offshore. Either way, this is a risk that sits on your books and something you need to be concerned and to worry about. These are some of the events that have led to sharper moves as far as the rupee is concerned, whether it was the 1991 BOP crisis or the fall in crude prices in 2006, and we're seeing a somewhat similar phenomenon here, but actually with different outcomes for various reasons, which I will go into later. But India is now a globalized economy. We are impacted and affected by what happens in the world. So whether it is Fed raising rates or whether it is what is happening with the Chinese economy, all of that has an impact on what is happening to the rupee, in addition obviously to what our own economy is doing and delivering. Uh, Given that, I want to just reiterate the importance of actually managing this risk, which is the FX risk that arises out of your portfolio. As I mentioned earlier, globalization has definitely translated to greater volatility. So if historically it was a local or local economy which affected what was happening to the rupee, today, given the fact that we have opened up our economy to foreign investors, to FDI flows, uh, our own domestic companies are large exporters and importers. We have local corporates are allowed to invest offshore in terms of acquisitions and mergers, etc. Not to mention, as individuals, you are planning a holiday abroad, you have your child's education to pay for, you are a parent of a child who remits money to you regularly. All of this gets impacted because there is a changing value to the currency on a day-to-day basis. A market as it forms provides opportunities to traders and requires asset managers and users, whether clients, individuals, a requirement to efficiently manage this risk. Whether you trade the risk or you manage the risk, you first need to understand it, you need to measure it accurately, you need to have a defined and a disciplined approach in terms of how you're going to run this risk, and then you need to find and use the best product available to match your needs. Like I mentioned, we'll move on to how currency movements affect you, whether as an individual or as a corporate or as an institution. Uh, at a macro level, as a country, your trade balance, so your difference between what you're importing and exporting, obviously has an impact on the rupee. Uh, it's circular because the value of the rupee affects what inflation is and vice versa. For example, if even if crude prices have dropped from 50 to say, or from 100 to 30, the fact is that rupee has moved from 40 to 65 or 68. Now, my import bill is impacted not just by the price of crude, but also by what is the value of the rupee, because it is a commodity we import. Similarly, the price of gold is affected by what is the value of the rupee, because again, India is a large importer of gold. For a country, our global competitiveness is impacted or affected by the value of the rupee in terms of how competitive my exporter is vis-a-vis, say, an exporter exporting the same item or commodity or a good which has been manufactured or a service that is being provided vis-a-vis a competitor from, say, China or Eastern Europe or Europe. As a corporate, I already mentioned this, what you are actually importing or exporting is affected by what is the value of the rupee, and therefore a need, as I highlighted earlier, for actively managing that risk is critical, is important. I'm a strong believer that uh, the risk exists, and not doing something about that risk is actually taking a view. So by not doing anything is not eliminating the risk. By not doing anything, you're taking a decision to live with the risk as it is today. Actively managing that risk is what requires a disciplined approach, and what requires that you can define more certainty as far as your balance sheet and profit and loss account is concerned. Again, as I mentioned, individuals, whether, let's take an example of somebody sitting in India who gets a regular remittance for, say, $1,000 a month. Now, sometime back, that $1,000 would have given you, say, 45,000 rupees, because the value of the rupee was 45. Or say, even if you think back to 2008, when we started, when we launched currency futures on the exchange, uh, we had a rate which was somewhere around 43 to 48. So maybe you got 48,000 rupees. Today you will get 68,000 rupees for the same $1,000. The question to ask is that if I am dependent on that remittance, then it may be prudent to say that I have the ability now to lock in what I may be expecting to receive in the coming months. Similarly, you have your child studying abroad, and you need to regularly make an outflow or a payment for that. You would have paid 50,000 or 60,000 last year, and this year you have to pay 68,000 for the same $1,000. What I'm trying to say is that if I'm trying to get a better prediction of my cash flows, so that I know that at any given point of time I am not going to suddenly have to pay more or receive less than what I have budgeted for based on my expenses. And whether I'm an individual or whether I'm a corporate or an institution, uh, managing that risk or hedging that risk is critical to my being able to effectively manage my balance sheet if I'm a corporate, or my lifestyle if I'm an individual. So again, whether you're planning an international holiday, whether you're buying an imported good, is impacted by what is the price of the dollar rupee. So for example, even the petrol that goes into my car is impacted by what is the dollar rupee price today. That is what I call indirect or economic exposures. Now this happens even with corporate entities. What I mean by that is that if I'm an entity who is manufacturing locally a product for which I have competition from an imported product, then the price of the imported product, which is determined by, is impacted by what is the foreign exchange rate, will have an indirect impact on what I can sell my product at. Because if, for example, if China can deliver something cheaper to me because of the currency, then what I can compete at, so what we call import parity pricing, is relevant to me even if I don't have a single dollar of direct foreign exchange exposure to my balance sheet. So given this background and this backdrop and this scenario, what are the products available as far as you're concerned? What are, I'll walk you through very briefly some payouts and cash flows in terms of what could happen if you use the exchange traded product. What is available on the exchange today as far as currency futures and options are concerned? We have the dollar rupee, we have the euro INR, we have the pound INR and the yen INR, which is traded actively. In the options space, we have USD INR, which is the dollar rupee. The the price, the underlying on which the future and the option is traded is the rate of exchange between the USD and an INR. So for $1, how many rupees do I pay or receive? The contract size is 1,000 US dollars. Now this is a huge advantage as far as even retail or the SME customer is concerned, because in the over-the-counter or the interbank market, we tend to deal in larger lot sizes, and pricing is inefficient for an individual or a corporate entity who looks at dealing smaller ticket sizes. But on the exchange, given the fact that it's a standardized product and the exchange mechanics work really on a margin and a collateral basis, what we offer every single customer who comes to the exchange, whether you are dealing as an individual or whether you are dealing as the largest corporate entity in the country, or if you are a foreign portfolio investor, the price you get is exactly the same, the margin you pay is exactly the same, your mark to market is exactly calculated the same way. So it is kind of an equality to all situation. We trade 12 calendar months. What I mean by that is that from today, if I was trading today, I have contracts starting February going all the way up to January of 2017, and every time the first month matures, a next month is added in. The final settlement day or the closing day of every contract is the last business day of the month. The tick size, as we call it on the exchange, is a minimum of a quarter paisa. What I mean by that is, if the rupee was 66.0025, a one tick move is 66.0050. Another important aspect of the product is that this is settled at the RBI reference price, and it is settled in rupees. What I mean by this is if I bought $1,000 worth of a single future for the month of February at a price of say 65, and that means my contract value is 65,000. Tomorrow this moves to 66, then the contract value is 66,000. What you will get on the settlement day will be 1,000 rupees. So basically what I'm saying is that this is cash settled on the difference of what your acquisition price was versus what the final settlement price is. Let's go through an example in terms of how this payoff would really work. So say for example, an investor expects that the rupee price today is 67, and I expect it to go to 68 in the coming weeks or months. You may obviously be a corporate who has to pay an import bill, or you may be an individual who, like I mentioned, may have to pay for their son's education. Either way, this is a potential strategy that would help you hedge this risk. So let's say you traded on the 7th of January 2016. The expiry of the first month January contract was 27th of January 2016, and the futures price was 67. And you bought one lot. So say you bought a futures contract. The value of that would be 67,000, which is 67 into $1,000, which is the value of the contract. On the exchange, as I'm sure most of you are already aware, you need to pay a margin to be able to trade. The margin has ranged between 3 to 5%. There was a brief period when the regulators had increased margins and it had gone as high as 10, but on average we are talking of a range of between 2.5 to 3.5, 4%. So 3%, as I've put in the example here, translates to about 2,010 rupees. What I want to highlight here is margin or collateral is what you pay when you have put on the trade, and that margin stays with the Exchange Clearing Corporation till the trade matures or you unwind it. Once you unwind the trade, this margin actually comes back to you. So when you're considering your cost for trading on the exchange, you're considering your funding cost of this 2010 rupees. The exchange, depending on whether you're a corporate entity, etc., accepts margins in different forms. We accept bank guarantees, we accept fixed deposits, we accept equity shares, we accept some mutual funds. So you can actually use some of your existing asset classes to be able to fund this margin. Um, Now on 20th of January is when you actually need to make this payment, or you've realized the value that you expected from your trade. You would look to unwind this trade. Let's take a scenario, which is scenario 1 at the bottom of your screen on the left. The futures price is 68. What I would do is I would now sell this future and I would have made a profit of 1,000. Now I want to highlight again here that your profit is 1,000 in terms of the cash that you will get as far as this trade is concerned. This does not consider the fact that you would have funded this margin. So for example, if on 2010 rupees your funding cost for the month was, say, let's just say, if your funding cost was 12% for the annum, so approximately 1% for the month, then you're probably looking at, say, 20 rupees there. So your cost of transaction cost is not what I have, and your funding cost is not what I'm deducting. I'm just highlighting to you what is your profit on the trade outright. Your scenario 2 is this trade does not work for you, and you actually have the futures price going from 67 to 66, contrary to what you believed would happen. You have the full ability to actually go and cut the trade at any given point in time. So say for example at 66 you decided to cut loss. You would sell the future again and your loss would be 1,000. You would add your funding cost to it, so your overall loss on the trade would be 1,000 plus whatever is your funding cost of the margin. In a similar strategy, I've highlighted a trade where the investor expects that the dollar rupee, which was trading today at 61 quarter, and you expect it to go down to 66.25. Again, let's take an example. You're expecting a remittance from your son or your daughter in the next month, and you believe that today the rupee is valued at 67 quarters. So if I'm going to get $1,000, I'm going to get 67,250, and if it actually moves lower, I would get that much less as far as my conversion rate was concerned. So on the 14th of December 2015, for an expiry which was 29th December, you sold a future for 67 quarter, and therefore your contract value is 67,250. A margin again at 3% estimation works to around 2,018 rupees. On 23rd of December, your move actually works as you expected, and therefore you decided to close out your position. You would then buy the future back, and that would earn you 1,000 rupees. Likewise, as I mentioned earlier, if it went against you and the market went to say 68 quarter, you would actually make a loss of 1,000 rupees. What is very important to highlight is that the exchange provides liquidity at all points in time, and you can actually enter or exit the trade even immediately after you have entered it, or obviously wait till maturity if you believe it is the trade that you want to stay with. The exchange also allows you to roll over your contract. So for example, you bought a contract today for the month of February. You can actually at the end of February look at rolling this over to March or April, or like I mentioned, we have contracts out to almost a year. So let's take an example of how a corporate or an individual would look at hedging their risks. So let's focus a little bit about actually using this product to hedge risks. So say for example, an individual wants to remit 10,000 US dollars to his son or daughter studying abroad, and on the 25th of February. And on 1st of February, I believe that the rupee, which is now trading at 67, might actually trade higher, and therefore I would like to lock into this trade, because I am mentally prepared to dole out 6,70,000 rupees for this, and I want to freeze my cost. What is very important when you are hedging your risk is you are looking at where you want to freeze or lock in your total cost of what you're aiming at achieving. So looking at the left of your screen, the futures rate for the February contract, for example, is 67. To buy 10,000 US dollars, you would have to buy 10 contracts. So you buy currency futures at say 67. Your notional value comes to 6,70,000. Again, assuming a margin of 3% of notional, your margin comes to around 20,100. As I mentioned earlier, your margin gets released on expiry day. On the end of the month, say for example, let's take scenario case 1, the dollar rupee rate is fixed at 68. What happens is that 68 is where the closing price is, and you transacted at 67. So on 10,000 US dollars, you make a profit, or you have a net earning of 10,000. You actually need to remit these dollars. So you would go to your bank and buy dollars from him, and what you would pay to the bank would be 6,80,000, because that is the current rate prevailing at the time. Now, what I want to highlight here is that your net cost after adjusting for this 10,000, which is the profit you made in your futures trade, would bring your total cost down to 6,70,000. Now, as I mentioned, the important thing when you're doing a hedge trade or when you're trading to actually lock into a price is to say that I want to crystallize my exposure. So what I mean by that is I know I have to pay 10,000 US dollars in a month's time or in 2 months' time or 3 months' time, and I want to freeze the cost of that today. I want to know today what is my exact expected cash flow going to be, and therefore this has locked in my cash flow at 6,70,000, excluding transaction costs at this point in time. Case 2 is where the dollar rupee goes to 66. Now in my trade at the exchange, I would have made a loss of 10,000. When I go to the bank, I will buy the 10,000 US dollars at 66, which means my total cost comes to 6,60,000 plus 10,000, which is my loss from the exchange. So my final cost comes to 6,70,000. What I'm trying to highlight here is that when you're hedging or when you are looking to crystallize a liability, what is important is that you know upfront that tomorrow I don't have to face the uncertainty of whether the 6,70,000 will be 8 lakhs or will be 5 lakhs. Now, it may work either ways because markets tend to, I mean, if we could all predict markets, and I think none of us would be, we wouldn't be needing to have this conversation. But the idea of hedging or crystallizing a cost is really about locking into or eliminating an uncertainty from my future as far as my cash flows are concerned. So this is just really an example of what I just mentioned, where I am talking about my payoff, whether I actually, if I trade at 67 and that is the cost I lock in, whether the rupee goes to 62 or whether it goes to 72, my net payoff is locked at 6,70,000. I haven't gone into details on how options would add some flavor to this. The same trade could also be affected through the options market, and you could actually change your payoff profile a bit depending on what your risk appetite was. I've just done a very brief comparison of a USD INR trade versus a Nifty trade with just a 1% move in price. So a contract size for 1,000 USD versus 75 Nifty, if I bought one contract, my traded price would be 67 and 77,500 on the Nifty. Uh, the notional value, as you see on the screen, my margin for Nifty, it's at about 10%. Um, my notional gain or loss is a price variation of 1 is say 670 on the currency versus 5,625. What is important to note, of course, is that the amount I'm investing in the currency contract is 67,000 versus what I'm investing in the Nifty is 5,62,500. Um, Let's move on to some market dynamics in terms of what really affects or impacts the value of the rupee. Um, there are a multitude of factors which impact the rupee. It is obviously a sort of an economic barometer of any country. The interest rates and the currencies are macroeconomic indicators of any country and tend to indicate how that economy is performing and what kind of flows, positive or negative, that country is seeing. What we have observed, and this is not to say that this correlation is sacrosanct and always exists, is really that a fall in equity markets usually tends to depress investor sentiment, and foreign portfolio investors tend to withdraw at times like this. So, for example, if you take the period of September, of June to September to 13, you actually see that when Nifty dropped substantially, you saw a sharp spike in the value of the rupee when it went all the way to almost 69. Um, Again, the recent fall from in the latter part of 2015, as far as equity markets are concerned, we have certainly seen a more continuous fall in the rupee also. So the sentiment in the local equity market is also affected, frankly, by global equity markets. So what I'm trying to highlight is that there is a strong correlation between what flows tend to do to the value of the rupee. Um, Again, as I mentioned, it is not that you will always find this indicator work because there is always a lead lag impact. But usually if you're seeing strong foreign portfolio inflows or outflows, it has tended to impact the value of the rupee in India. Again, crude oil price, or for that matter, even gold prices, have tended to have a strong impact on what is the value of the rupee. Crude constitutes almost 70% of India's total imports. It's obviously a little lower now given the fact that prices of crude have fallen as much as they have. And crude oil prices again are denominated in dollars. An increase in those prices affects our import bill and vice versa. And you will miss phases when a sharp rise in, again, if you see that the 13 period, you saw a rise in WTI prices which were all higher than about $100 a barrel, and that did cause, which when combined with the move in the equity market certainly led to a very sharp spike in the rupee, where we saw it moving from almost levels of 60 to a level of almost 69. Interest rates and the rupee. Again, the value of a country's currency also is strongly impacted by what are the interest rates in that country. So if interest rates are expected to, are rising or expected to rise, you usually tend to see a lot of foreign portfolio investors looking at the local debt market to take advantage of higher rates, because India does offer a much higher return compared to what the rest of the world does today. Again, interest rate differentials tend to define values of currencies. Of course, this works perfectly when you have full capital account convertibility, which we yet don't. However, there is obviously a very strong relation to what interest rates impact as far as currency is concerned. Uh, Lastly, I would just like to go through what is the participation process if you wanted to participate on the exchange in the currency futures and options segment. You basically, the process firstly I would like to highlight is exactly the same that you would do for your equity or your commodities investments. You select a trading member or a broker. The exchange parlance for the same is a trading member. You need to complete your KYC, which is a regulator mandated requirement. So you need to complete the KYC. You are set up as a client. You receive your client code, ID, etc. You then need to, for a futures or options trade, you need to, in any segment in fact, you need to post a margin that is pre-trade. um, Posting the margin allows you to actually enter the trade on the system. Your broker may provide you their own front end, because there are many of us today who trade through apps or through online trading platforms. You can also be calling your broker for a trade and vice versa. Um, Once you've posted your margin, you are actually ready to trade. There is in the futures and options market a requirement for a daily mark-to-market, which the exchange provides your broker at end of day, and the pain or the payout of that. If you are in the money, the exchange clearing corporation through your broker will give you a credit to your account in mark-to-market terms, and vice versa if you are out of the money. On the NSE website, you will find something called the FX Tracker, which is a live update on where the currency market is trading. I would urge you to actively look at that for an idea in terms of what are the prices, what are volumes, how we are trading, what is the movement vis-a-vis other currencies. It will give you a fairly good idea in terms of what the currency markets are doing. Uh, Very briefly, the futures contract specifications, I've already talked about this earlier. I'll just go through it very briefly. It's 1,000 US dollars with a tick size of 0.25 paisa, which is 0.0025 rupees. Trading hours today are Monday 9 to 5. We have a 12-month trading cycle. The expiry is 2 days prior to the last business day of the month, which really follows spot settlement. The final settlement day is the last working day of any expiry month. Margins are span based, identical to what you do in your equity and equity F&O business. There is an extreme loss margin, which is 1%. As I mentioned, the total tends to work to somewhere around 3 to 5%, actually usually lower than 5. The daily settlement is on a T+1 basis, and the final settlement is T+2. The mode of settlement is it's cash settled in Indian rupees. The daily settlement price is the last half an hour weighted average price, and again, exactly as it happens in the equity F&O segment. And the final settlement is the RBI reference rate. In options, we have premium style European call and put options. The premium is quoted in INR. The unit of trading, the tick size, trading hours all remain the same as futures. The contract trading cycle is we have 3 serial month contracts followed by a quarterly contract. At any given point of time, we have a minimum of 12 in the money and out of the money, including one near the money option. The strike price intervals are 25.25. The expiry, etc., all remains the same. The final settlement day, the daily settlement, etc., is all as it is in the futures and the OTC market. Premium is paid +1. It is again a reference to the RBI reference price on expiry. With that, I'd like to thank you again for this opportunity to present this product to you. And I'd like to again thank ET for hosting us, and thank you very much. And I'm open to any questions you might have.
Thank you, Ms. Mistry. That was a pretty exhaustive presentation. You can now open your chat room on the right side of the screen and check your questions. You can also post your questions on Twitter at hashtag #ETMarketsWebinar. So, Ms. Mistry, we have quite a few questions already. Mr. Brij Singh says, has a question. He wants to know what will be the range for INR versus US dollar till March 2016.
That's the one question I'm actually dreading. But honestly, as an exchange, I don't think I'm at liberty to share. I want the chat room. Oh, there is. Okay. So essentially, honestly, as an exchange personnel, we are platform providers. We provide you an opportunity in terms of how you can trade this risk or manage this risk or hedge this risk. Predictions on the rupee or the equity markets, unfortunately, is not our forte as far as an exchange business development head is concerned.
So taking cue from what you can answer, Mr. Raghav Kharia, he wants to know how you can use options to hedge receivables.
Sorry, come again?
He wants to know how you can use options to hedge receivables.
Okay, perfect. So basically, I'm an exporter. I'm exporting to, I'm expecting a receivable, say a month down the line. I would go and look to buy, depending on my expectations, on I would say buy a put, because I want to be able to sell at a future date. So I would look to go and buy puts at a forward date, depending on whether I want to select a strike which is 70 or 71, or even if I'm expecting it to go lower, then I would buy a put at a lower rate from here. So essentially we have calls and puts on the platform, and that is what you can use to hedge your receivables.
Here is Mr. Praveen Reddy. He wants to know other currency markets are open 24/7. Without such facility, will NSE products be competitive to take advantage of situations?
Well, obviously having a 24-hour market would help. But the OTC market, see, as far as onshore markets are concerned today, the OTC and the exchange both have a timing of 9 to 5. So if you are a domestic resident, you are only allowed access to domestic markets. So as far as the domestic population is concerned, you are accessing only local markets, and therefore a domestic corporate or a domestic institution or a domestic entity can only access the local markets. So that is only a 9 to 5 market today. I'm sure we've all seen some reports which talk about a thought process which is looking at extending exchange market hours, and once that happens, obviously we will have a longer trading session also.
All right. So we have Mr. Aman Agarwal. He wants to know which is a safer instrument to hedge. Is it options or is it futures?
So, like I said, a future is you directly lock in, and it has a linear profile. A future is if market moves 1 rupee up or down, my payoff is exactly the same. I mean, I make, if I buy at 67 and it goes to 68, I make 1,000. If it goes to 66, I lose 1,000. Options allows me more flexibility because the profile is non-linear. So for example, if I have bought a call at 68, I pay a certain premium for it. If it goes to 69, then I exercise that call, and my return is that I is on the higher side if I'm in the money. However, if it goes lower, I don't lose the same amount of money. What I lose is only the premium that I have paid. Now again, this is really when I'm a buyer of options. So if I'm a willing payer of premium and I have bought an option, then my loss is restricted to the premium I have paid. Whereas in a future I have locked in, so my profile is basically that I have made that money or I have lost, or rather I would say I have locked into options. Also allows me more flexibility. I may actually do a combination of trades where I can express a more combined view. I expect, for example, rupee to go to 70, but I don't think it will go beyond that, or I think it might go to 65, but I don't think it will go below that. So options gives me much more flexibility, but you have to realize that if you're a seller of options, you do take on more risk, because then you have a risk on the lower side. So it depends on what you are using the product for. Uh, Options though does provide you a lot more flexibility, and if used correctly can be a very, very effective hedging mechanism.
All right. So we have Mr. Sriram MS. He wants to know how is the liquidity and depth of USD INR options, and is it as liquid as say Nifty?
Actually, the simple answer is no, it is not as liquid as Nifty. But what I would like to add is that it is adequately liquid. So we trade in dollar rupee options somewhere to the tune of um, um, $1 billion to $2 billion a day. The large part of the trading does happen in the at the money and the out of the money options. So it is certainly adequately liquid in terms of size, because what I'm talking about is anywhere between 5 to 10,000 crores in terms of what we trade in options in rupee terms, which I said is anywhere between $1 billion to $2.5 billion. We have a large open interest also, so it certainly allows you to trade.
All right. So we have Mr. Lavish Bansali. He wants to know, is there a minimum lot to trade? I guess he's asking about options here.
The minimum you can trade one single lot, which is $1,000. What is important to note is that the rupee being something that we're not fully capital account convertible, there are limits which are prescribed by the regulators in terms of how much you can trade. So while I know the answer, the question is more in terms of a minimum lot size. The minimum lot size, like I said, you can trade a single contract, whether a futures or an options contract. That is $1,000 valued at today would be around whatever 66 to 68,000 rupees. Um, um, on the max side, if you are an resident individual entity, either you can trade up to $1,000 without having the need of any underlying. Um, if you are an entity who actually has some exports or imports or capital accounts, then by a CFO certification, you can go and hedge up to 6% of what is our open interest, which today I think translates to a fair amount of value.
All right. We have Mr. Tanud Saxena from Ghaziabad. He's saying, is India Inc. deploying hedging strategies aggressively amid rupee volatility? And has the overall hedging by India Inc. via NSC gone up in the last 1 year?
Whether India Inc. as a whole has increased their hedged portfolio, honestly, I don't think that data is available publicly, in the sense that I think the OTC data goes to the Reserve Bank of India, and I don't think they publish outright what is the hedged portfolio. I know that there are attempts to make it more transparent and make that information available. Having been a banker for some time in my life, though my own experience has suggested that in India exporters tend to hedge more than importers do. I don't necessarily believe that's the right strategy, because if I'm an importer and I suddenly see rupee having gone from 60 to 68, then I'm definitely hurting. So I think what is very important is that every corporate entity certainly needs to have a very strong risk management policy in place, and then be disciplined about sticking to it. So if I am committed to saying that I will, then you can't trade around your risk management. What I mean by that is that if I have taken a decision that at any given point of time, through either futures or options, I will keep, say, 50 or 60% of my exposure hedged, then I should consistently follow that policy. We have definitely seen some corporates who actively risk manage their portfolios, and what usually I think, I won't even say usually, what always pays off is consistency. Because if you have a policy and then you decide that, today I think I'm going to be 20% hedged, and tomorrow I'm going to be 0 hedged, and the day after I'm going to be 100 hedged, then that is where you introduce challenges, because I think a disciplined approach to hedging is what works. And I think as having once been a practitioner, I think that is what I would definitely recommend.
All right. So taking cue from that, Miss Nandini Banerjee from Kolkata, she wants to know, are rupee FNOs meant only for hedging, or one can even make money out of them? They can look at making money around it.
Absolutely. It is not at all meant only for hedging. In fact, I think any market needs a good mix of traders, hedgers, arbitragers, users, etc. So no, absolutely you can use this product to trade the product as well. Like I mentioned to begin with, this is an asset class, and it's a new asset class that's actually available to people for even taking views on what the dollar rupee is.
All right. So we have Mr. Rakesh Sharma from Faridabad. He wants to, his question is, do you see any correlation between trade volumes in currency markets and rupee fluctuation? Is there a rise in volumes in the latest round of rupee weakening?
Yes, it usually tends to happen with most markets. We have also observed a rise in volumes when we've seen more volatility. So higher volatility does tend to bring in more volumes, yes. Because more people come to hedge, more people come to trade, more arbitrageurs come in. I mean, people tend to step up because I'm expecting my return of investment tends to be higher when rupee is more volatile.
All right. Mr. Sriram MS again has a question. He wants to know, for Nifty, you have extensive historical data for various options and option strikes. Even going to the year 2015 and earlier, how is the situation in currency options?
So we certainly have data available on all of that. So the data is definitely available for currency options also, if I'm understanding your question right.
Yeah, sure. So the next question is from Mr. Manoj Farkande. He wants to know how you can maintain risk versus reward ratio in currency market.
Um, how you maintain risk versus reward in currency markets. So basically, like, what I would really answer for that is, I'm assuming here the question is basically leverage, and I think ultimately the margin for any product is a function of the volatility in that product. So as I highlighted in a slide, margins for currency are lower than what they are for Nifty, and therefore the return, obviously for the same rupee that I invest, my returns would be a function of what is the volatility and the margin in that product. Uh, risk reward is really finally about, I think, your own discipline in terms of whether you are a trader or a hedger.
All right. So this is, I think we'll just take the last question over here. Mr. Shivanand Yalsangi wants to know what is your overall macro take on the market situation in the light of what BOJ, ECB, and Fed comments are.
So I think the one word I think that would describe probably markets in the near future is volatility. So I think there is enough happening around the world, whether you look at the US, which is an economy actually which is seems to be improving as far as their macroeconomic fundamentals are concerned. Europe is still having its own problems, and there are no signs of QE ending there. Asia, which has so far kind of held the world together, is seeing an extremely long run of China's very strong GDP growth being impacted. That has obviously created a lot of ripples across the world. Um, Commodity prices being what they are, large uh, the Middle East or Australia or the down under where you look at it, the large commodity producers are impacted. So I think India in some ways is a sort of the beacon of hope. So I think a lot of people are looking at how India performs in 2016. A lot of eyes are focused on us, and I think we have interesting times ahead. The budget should be a
All
very
right.
event for us.
All right. Thanks a lot, Ms. Mistry. And also to our esteemed audience, especially those who took part in in this very actively. We have not been able to take a whole lot of questions for the dearth of time. We hope to address it next time. And for a link to this webinar and the presentation, do follow us on Twitter and our Facebook handles. Have a great day. Thank you.
Thank you very much.